Hey, everybody, it's Larry Berman here. End of summer, depressing time of year for me. Golf season's winding down. I literally have the Ryder Cup on the TV next to me here. So if you see my eyes going like this, it's because Rory's made a good shot or something's going on there. But we learned a lot this week about markets. A lot of commentary coming out of pretty high profile market people, and let's take a dive into the chart room and specifically let's take a dive into the internet, because there were some interesting things we learned about growth and inflation. There are several Fed district banks that do their what's called nowcasting, forecasting of what growth is likely to be. And while what inspired the most recent set of rate cuts was a weakening in the economy overall and the labor market in particular, since the Fed cut interest rates, everything's kind of turned around, because the Atlanta Fed now forecast or nowcast is looking at 3.8% GDP for the current quarter. The New York Fed's nowcast, with an uptick this week, is looking for 2.5% growth. Yet the St. Louis Fed's news index, that also does a similar type of forecast, is down at just a hair above, a flat economy in terms of its third quarter forecast. The Cleveland Fed, that now casts inflation, we look at those numbers, and we're continuing to inch up and tick up in recent months here. So you've got this growth and inflation picture that is confusing at best, and market response this week was to undo some of the things that we saw that were starting to get priced into the market in the days after the Fed rate cut. Pivoting into our Bloomberg terminal here, looking at the initial claims numbers. So last week we said, well, we had that spike up in initial claims. Everyone started to really get worried about it. 4-week moving average was moving up. We had already seen 4 consecutive payroll reports with really anemic job growth numbers. And all of a sudden you get two weeks back to back of really benign numbers, taking the indicator back into the lows of say this year. And so while the labor market certainly hasn't healed, if the economy in Q3 is really firing at 2.5 or 3.8%, as compared to the St. Louis Fed that think it's a lot weaker, then those job growth numbers probably get revised up at some point. So a lot of confusing signals to the market. When we look at the short-term interest rate market, so this is the June 2026 futures contracts, and post-Fed cut, we got into an area where we were looking for more aggressive Fed cutting. And then really, as the data came out in the past week, again, stronger growth and inflation numbers, that pullback happened. So when we look at some of the ancillary ways of measuring data, the alternative ways of measuring data, Bloomberg has this very neat function here, alternative data company analysis, where they look at web traffic. They look at some of the artificial intelligence ways of measuring foot traffic by way of CCTVs and other things where they're pulling data and looking at things to try to forecast what's happening in the industry regarding consumer. So Walmart is the benchmark for the consumer, or one of them anyways, in terms of food, groceries, moderate to low end consumer. And, web traffic seems really high. We know there's growth rates there. Walmart's doing better than the industry in that regard overall, year on year. Remember, these are not real numbers, they're nominal numbers. So, the consumer's struggling. Very, very mixed pictures. What's driving the economy now really seems to be this reshoring, onshoring, AI spend, everything related to that, and very little else. When we look at the AI ETF, this week we saw NVIDIA buy into / lend $100 billion to OpenAI to buy more chips. That probably shows up in massive increase in accounts receivable. Anyways, TBD on that. We heard from David Einhorn, famous value investor, very, very concerned about what's going on in AI in terms of the valuations and the spike. So again, big spike up here. It's not a short because you don't want to try to figure out when this thing's going to peak, but you gotta say you're paying a lot for everything AI these days. What does it mean for the S&P 500? Market keeps grinding higher. We get these 1, 2, 3 day pullbacks, and there's no follow through to the downside. So until the market breaks, that's going to be a telltale sign. So we now have 2 weeks in a row here where we had spikes down, and then the market kind of buys back. We're not closed yet here on Friday. It's around 3:30 at the moment. But we saw, again, weakness on Thursday. Week before, we saw weakness. Market hasn't broken, so we still see these higher highs and higher lows. We have to start making lower highs and lower lows before we start to really get concerned about the trend changing on us here. And until we see that, you can expect it to keep going higher. So what will happen first week in October? Don't know, but what is the market going to tell us it does by way of higher highs and or lower highs and lower lows? So that's what we're looking at now on the charts as we get into October. September, which is supposed to be a bad month for markets, and we look at it, positive month. So seasonals were supposed to be negative, didn't matter so far this month. There's still a couple of days left, but so far it doesn't matter at all. Will October matter? Hard to say. But if we're not weak in September and October, you can likely expect that the fourth quarter strength of November and December is muted on the back half. That's at least been some of the historical data where we haven't got the seasonal pullback in September and October. Have a good week, everyone.